Hey, do you ever feel like you're taking a trade and it goes against you immediately and you don't understand what happened? There's a thing called liquidity. ICT explains it as equal highs and equal lows, or relatively equal highs and relatively equal lows, where stops are resting for buyers or sellers in the market. When they get stopped out, a lot of orders come in and liquidate them to then go the opposite way. To explain it in a more plain way, it's just highs and lows where price should be rebalancing to, repricing to, taking those highs or lows in order for the market to then continue doing what it was doing, or reversing from where it was coming from to then continue on a higher time frame idea uh, that was supposed to be happening. Now, how do we know where these areas are? That portion can sometimes feel very subjective unless you have an actual executable model. I am making a YouTube series where I'm going to explain all the ICT concepts, kind of condense them in a really simple short form video so you guys can get all the information instead of having to watch all the videos that I did from ICT when I was in my journey studying his stuff. And then we're going to be doing a series where you can make your own executable model that is simplified into just a few steps, and then you can enter the trade based on that. Now, let's look at some examples of what liquidity looks like and where it can be coming from. The first thing is that there needs to be obviously some sort of narrative, some sort of story on why you think price should be going from point A to point B. In this case, it's really easy to tell that price is obviously going down in the market. I mean, we've been dropping continuously for a few days now. So chances are it's probably going to be bearish, right? If we look at this, we have a CISD here, changes set of delivery to the downside. We have a swing low, swing high, swing low. That's our first high that gets made. We then have price come down, come all the way back up. And as you can see, this high is here as well. This high is here as well. This high is here as well. But there's no CISD to the downside after all of those highs get put into place. Now, once we run this high, which was the very first one, we then see CISD, which is here, changes set of delivery. We also have a breaker block to the downside. Now, here is where you can start having your entry model. You can either do the CB after the high gets ran. You can do the order block, which would be this two yellow candles. You can do the breaker block, which would be this bottom candle. There's multiple entries, and depending on what you were doing, your stop loss will be always the same. It's still on the high, but your entry would have been looking different. Obviously, the higher you can get it, the better risk to reward you will get. The lower it is, the less risk to reward you will get. Now, not every single entry will come all the way back up to the edge and give you a tight entry like so. Some of them will just kind of run after the CISD. But the idea is just this is the first high or low after a change in set of delivery happens. And then there's more highs that get made after, but don't quite take it. And then once it does, the market is ready to then run. We then see the same thing here. We have obviously structure, price goes down, CISDs, we come all the way back up. When we come all the way back up here, we have this high, right? We have this high, price runs both of those. We then have a change in set of delivery here. We also have a breaker block, which is this candle. And then what do we have? We have either you could have after this happened, you could have either entered the breaker block by itself, or you could have a double confirmation. We then have a high get made here, another high, and another high. So three highs back to back. And price is just kind of slowly trickling down. He then runs those really fast, takes the high, and then what do we have? We have our CB, IFEG. We also have CISD and breaker block. So then we have all the PD arrays we need. ICT always says three PD arrays is basically what you need to have an entry. Those are your three PD arrays back to back. Breaker block, IFEG, FEG, and then you have an entry. Now, where would you enter? It just depends on what um, PD array you're going to be utilizing. You could have used the fair value gap, the IFEG, or the breaker block. Depending on which one you use, obviously, again, your risk to reward changes, but you're not always going to get fill. If you waited for this the CB, for example, until the breaker block got confirmed, you wouldn't have gotten tagged in because price never came back to retest the CB after he came back before he confirmed the new CISD. If you enjoyed the video, please subscribe. I'll be bringing more videos like this. I'm dropping a few more videos this week explaining the order block, the breaker block, fair value gaps, as well as changes set of deliveries.